All right. Hey, everyone. I'm really glad you're here today. Let me start with something most people don't realize until it's already happened. Before December 31st, there are a few simple Social Security steps that can protect your benefits for the entire year ahead. And what's surprising is that missing just one of them, even something small, can lead to reduced payments, delays, or unexpected deductions in January. And the part that frustrates a lot of folks is this: the government doesn't send reminders for most of this. No warning, no checklist in the mail. So, yeah, today I want to walk through what you should still double check before the year ends and what to watch for as January hits. One of the things we'll talk about later is something almost nobody checks, but it causes issues more often than you'd expect. So, stick with me. And before we get into it, let me ask you something real quick. What's one thing about Social Security or Medicare that has felt confusing, stressful, or just unclear to you this year? It could be anything. Drop that in the comments because chances are someone else feels the exact same way, and reading your comment helps them too. So let's talk about what really matters before December 31st. And yeah, I know people hear checklist and tune out, but stay with me because these are practical things, not paperwork for the sake of paperwork. The first one is probably the most important, and it's checking your Social Security earnings record. Your benefit is calculated using your highest 35 years of earnings. That means if even 1 year is missing or recorded incorrectly, your benefit can be permanently lower. I've seen people lose money every single month for life just because one employer didn't report income correctly years ago. When you log into your My Social Security account, you'll see your earnings history listed year by year. Take a few minutes and scroll through it. If you see a year marked 0 when you know you worked, or if a number looks way too low, that's a red flag. You can correct errors, but it's easier to fix them sooner rather than later. And here's something important. Social Security uses your highest 35 years of indexed earnings. If you worked less than 35 years, zeros get averaged in, which brings down your benefit. If you worked more than 35 years, only the highest 35 count. So if you're still working and earning more now than you did earlier in your career, those new higher earnings can replace lower earning years and actually increase your benefit. That's why checking this record isn't just about catching errors. It's also about understanding how your current work might be helping your future benefit. And if you spot something wrong, you'll need documentation. Pay stubs, W-2 forms, tax returns, anything that proves what you actually earned. The SSA can't just take your word for it. They need proof. So if you notice an error, start gathering those documents now rather than scrambling later. If you're receiving disability benefits, this matters even more because reporting work activity is required. Even small amounts of earnings need to be reported. If they're not, overpayment can happen, and then Social Security may ask for money back later, which is never fun. And let me be clear, overpayments aren't just inconvenient. They can be financially devastating because the SSA can withhold your entire benefit until the debt is paid back. Another thing to take care of before the year ends is tax withholding. A lot of people forget that Social Security benefits can be taxable depending on your total income. If you earn more than $25,000 as an individual or $32,000 as a married couple filing jointly, you may owe taxes on part of your benefits. These thresholds are based on something called combined income, which includes your adjusted gross income, plus any non-taxable interest, plus half of your Social Security benefits. If you're above those thresholds, up to 50% of your benefits can be taxable. If you're well above them, up to 85% can be taxable. And yes, those thresholds haven't changed in decades, which means more and more seniors are getting hit with taxes on their Social Security. If you want to avoid a surprise at tax time, you can choose to have federal taxes withheld from your Social Security check using Form W-4V. It's optional, but many people find it gives them peace of mind. You can choose to withhold 7%, 10%, 12%, or 22% of your monthly benefit. The form is simple, just one page, and you can submit it online through your My Social Security account or mail it in. And speaking of taxes, it's worth mentioning that President Trump's One Big Beautiful Bill Act created an additional $6,000 standard deduction for seniors. That applies if you're 65 or older, and it can reduce how much of your income is taxed. It's set to last through 2028, and a lot of people still don't realize this change is already in place. It doesn't increase your Social Security check, but it can help you keep more of what you receive. For a single senior, this means your standard deduction would be around $21,750 instead of $15,750. For married couples, both over 65, it could be over $46,000. That's significant tax savings that many seniors are leaving on the table simply because they don't know about it. Now, let's talk about something that seems simple but causes major headaches when it's overlooked: direct deposit. If your bank account changed this year, your bank merged, closed, or updated routing numbers, make sure your Social Security direct deposit information is current. If a January payment gets sent to a closed or incorrect account, it can take weeks to get reissued. Updating this before December 31st can prevent a lot of stress. And I'm not exaggerating about the timeline. When a payment bounces back, the SSA has to verify your identity, confirm the new account, and then reissue the payment. That process can easily take 3 to 4 weeks. Imagine starting January without your Social Security payment. That's rent money, grocery money, medication money. For most seniors, that payment is everything. So if you switched banks, opened a new account, or if your bank sent you a new debit card with different numbers, log into your My Social Security account right now and verify those details. While you're at it, make sure the name on your bank account matches the name on your Social Security record exactly. If you recently got married or divorced and changed your name, both records need to match. The automated system doesn't understand variations. It just sees a mismatch and flags it for review. Now, let's talk about Medicare, because this is where things start to feel confusing right after the year turns. Since you may be watching this past the December 7th deadline, Medicare open enrollment for 2026 has ended. That means most people's Medicare choices are now set and will start January 1st. If you stayed in your plan, that's the plan you'll have in the new year. I want to say this clearly: if you missed the deadline, you didn't mess up. It just means you need to understand what happens next so you're not surprised. One of the biggest changes people notice is the Medicare Part B premium. For 2026, the standard Part B premium is increasing to $200.90 per month. And for most people, that amount is automatically deducted from their Social Security check. So when January comes and your payment looks lower than expected, this is usually why. Your COLA went up. But Medicare also took a larger share. So the increase doesn't always feel like much. Let me break down the math, because this catches people off guard every single year. Let's say you were receiving $1,800 a month in 2025. The 2.8% COLA adds about $50. But if Medicare Part B went up by $26, you're only seeing a net increase of $24. That's barely noticeable. And for some people, other Medicare costs like Part D premiums or supplemental insurance might increase too, eating up the rest. And even though open enrollment has passed, you're not completely out of options. There are special enrollment periods that allow changes in certain situations, like if you move, lose other coverage, or your plan leaves your area. Also, starting in January, there's a separate Medicare Advantage enrollment period where some people can make adjustments. Not everyone qualifies, but it's important to know that the door isn't completely shut. The Medicare Advantage open enrollment period runs from January 1st through March 31st. During that time, if you're already in a Medicare Advantage plan, you can switch to a different Medicare Advantage plan or go back to original Medicare and add a Part D drug plan. You can only make one change during this period, so choose carefully. Now that your plan is set, this is actually the best time to understand how it works. When you receive your first explanation of benefits, review it. Make sure your doctors are still in network, confirm your prescription coverage, and pay attention to prior authorization rules. Many Medicare frustrations happen because people find out how their plan works in the middle of a medical issue instead of at the start of the year. Call your doctor's offices in early January and confirm they're still accepting your insurance. Networks change, and the last thing you want is to show up for an appointment only to discover your doctor is no longer covered. If they're not a network anymore, you have that Medicare Advantage enrollment period to potentially switch plans. For prescriptions, check your plan's formulary, the list of covered drugs, make sure all your medications are still covered and at the same tier. Sometimes plans move drugs to higher cost tiers or require prior authorization for medications that were previously covered without hassle. If you see changes that will cost you significantly more, that might qualify you for a special enrollment period to switch plans. Also, remember this. Even though plan enrollment is closed, help programs are still available. Programs like Extra Help or Medicare Savings Programs can still be applied for throughout the year. These programs can help cover Part B premiums or prescription costs, and after COLA changes, more people become eligible than they realize. Extra Help, also called the Low Income Subsidy, helps pay Medicare Part D drug plan costs. If you qualify, you could pay nothing or very little for your prescriptions. The income limits for 2026 are $23,000 for individuals and $31,000 for couples, but those numbers include some income exclusions, so you might qualify even if you think you earn too much. Medicare savings programs help pay Medicare premiums and sometimes deductibles and co-pays. These are state-run programs with slightly different rules in each state, but they can make a huge difference. Some people who qualify don't even realize these programs exist because nobody told them. Now let's circle back to the COLA itself. For 2026, the cost of living adjustment is about 2.8%, which adds roughly $60 a month for the average beneficiary. That helps, but when you combine it with higher Medicare premiums, increases in rent, groceries, and utilities, many people still feel squeezed. And this is important. That COLA increase can push some lower-income seniors just over the income limits for programs like SNAP or Medicaid. So before the year ends, it's a good idea to check eligibility rules if you rely on any assistance programs. This is called the benefits cliff, and it's a real problem. You get a small increase in Social Security, which sounds good, but that increase makes you ineligible for other programs that were helping you pay for food, housing, or health care. The result is that you end up worse off financially, even though your Social Security went up. If you're close to the income limits for any program, talk to a benefits counselor now. They can help you understand what's coming and potentially find other programs that might help. Many states have SNAP programs with higher income limits for seniors or utility assistance programs or property tax relief. There are options, but you have to know where to look. Another thing to think about is your earnings this year if you took Social Security early. If you're under full retirement age, there's an annual earnings limit. For 2025, that limit was $22,320. If you earned more than that, Social Security withholds $1 in benefits for every $2 you earn over the limit. In the year you reach full retirement age, the limit is higher, $59,520 in 2025, and they only withhold $1 for every $3 over the limit. And importantly, they only count earnings before the month you reach full retirement age. After that, the earnings limit disappears entirely. Exceeding the earnings limit can cause Social Security to temporarily withhold some benefits. And for those receiving disability benefits, income rules are very specific. For SSDI in 2026, you can earn up to $1,620 per month, $2,700 if you're blind, before your benefits are affected. This is called Substantial Gainful Activity, or SGA. Reviewing what you earned and making sure it's reported correctly can prevent problems next year. If you went over the limit and didn't realize it, Social Security will eventually figure it out and start withholding future payments to recover what they overpaid you. Getting ahead of this prevents surprises. Now, here's something almost no one checks, and this causes more issues than you'd expect. Make sure Social Security has your correct mailing address and phone number. Important notices, benefit reviews, and verification requests are sent by mail. If they go to the wrong address and you don't respond, benefits can be delayed or suspended. Updating your contact information takes minutes, but it can save months of frustration. Think about how many times you've moved or changed phone numbers over the years. Did you remember to update Social Security every single time? Most people don't. And these aren't just casual updates or newsletters. Some of the mail you get from Social Security requires a response within a specific time frame. If you don't respond because you never received it, the SSA assumes you're ignoring them and can take action against your benefits. Your email address matters too, especially if you have a My Social Security account. The SSA now sends some notifications electronically, and if your email is outdated, you'll miss them. Plus, you need a current email and phone number to verify your identity when logging in, so keeping this updated protects your account security. I also want to step back for a moment and talk about the bigger picture. Social Security is under pressure long term. Current projections show the trust fund facing challenges in the mid-2030s if Congress doesn't act. That doesn't mean benefits disappear, but it could mean reduced payments. According to the latest trustees report, if nothing changes, Social Security will only be able to pay about 83% of scheduled benefits starting around 2034. That's not a doomsday scenario where Social Security ends, but it would mean a significant cut for everyone receiving benefits. Staying informed and making sure your benefit is calculated correctly now is one way to protect yourself in the future. If your benefit is too low now because of errors in your earnings record, and then future benefits get cut by 17%, you're doubly hurt. Maximizing your benefit now gives you the strongest foundation possible. Congress will likely act before 2034 to shore up the program, whether through tax increases, benefit adjustments, or a combination of changes. But we don't know what those changes will look like yet. That's why it's important to pay attention and advocate for policies that protect seniors. So every day I hear from people who worked their entire lives and are still struggling to make ends meet. Seniors picking up part-time work in their 70s and 80s, helping family, covering medical costs, and doing their best with what they have. That's why these year-end checks matter. They're not about paperwork, they're about stability. I've talked to people who lost hundreds of dollars a month because of an error they could have caught. I've heard from folks who had their benefits suspended because mail went to the wrong address. I've seen seniors pay thousands in unexpected taxes because they didn't know they could have had withholding. These aren't just statistics or hypothetical situations. These are real people, real families, real lives being affected by small administrative issues that could have been prevented. And the frustrating part is that the system doesn't make this easy. The SSA doesn't send you a year-end checklist. Medicare doesn't remind you to review your plan details. You have to know to do these things yourself. That's where I come in. My goal is to give you the information you need in plain English, without the jargon, without the confusion, just clear, practical advice that you can actually use. So let's quickly revisit what matters most before December 31st. Check your earnings record, log into My Social Security, and verify that all your years of earnings are recorded correctly. Look for zeros that shouldn't be there or amounts that seem too low. Review tax withholding. If you might owe taxes on your Social Security, consider filing Form W-4V to have taxes withheld automatically. And remember that new $6,000 senior deduction that could help reduce your tax burden. Update direct deposit. Make absolutely sure your bank account information is current and matches your Social Security records exactly. One wrong digit can delay your payment for weeks. Watch Medicare deductions. Understand that your January payment will likely show a higher Medicare Part B deduction. That's normal, but it's good to know so you're not surprised. Confirm your contact information, verify your mailing address, phone number, and email with Social Security. These need to be current so you don't miss important notices. Understand how your benefits change in January. Whether it's COLA adjustments, Medicare premium changes, or earnings limits, know what to expect so nothing catches you off guard. Check assistance program eligibility. If you're close to income limits for SNAP, Medicaid, Extra Help, or other programs, verify your status after COLA kicks in. A few minutes now can prevent months of stress later. And I'm serious about that. I've seen people spend half of the next year trying to fix problems that could have been prevented with 30 minutes of checking before December 31st. If there's one thing I want you to take away from today, it's this. Social Security is something you earned. It's not a handout, it's your money. You worked for decades, you paid into the system, and you deserve to receive every penny you're entitled to. Taking these steps helps make sure you actually receive what you worked for without delays, without reductions, without unnecessary complications. This isn't about jumping through hoops. It's about protecting something you've earned and making sure the system works the way it's supposed to. If you want to go deeper on any one of these topics, just leave a comment and let me know. Seriously, I read every comment. If there's something you want me to explain in more detail, or if there's a Social Security topic I haven't covered that you need help with, tell me. Your questions guide what I create next, and make sure you're subscribed because the coming year will bring more changes, and I'll be here explaining them calmly, clearly, and honestly. No hype, no scare tactics, just straight information that you can trust and actually use. Take care of yourselves, and I'll see you again soon. Thanks for being here today, and I hope this helped you feel more prepared for 2026.